I understand that you received a report of the ratios for this company, and I wanted to take you through a few issues that you would want to understand before you can rely solely on these particular ratios to make your decision. I want you to note that ratios rely on historical data, and we can say ratios are backward looking. Reliance on historical accounting data may not reflect the prevailing market conditions or anticipated changes in the market conditions. Ratios can easily be manipulated to show good financial performance, like, for example, inflating the current ratio, show the company can cover its short-term debt obligations. Relying on such information can lead to making wrong investment decisions, like advancing credit to the business, for example. Ratios are not comparable across industries. A great ratio analysis, for instance, a manufacturing company cannot depict the same market condition for a construction company. These disparities make the ratios unreliable if used alone when analyzing the performance in a multi-industry context. If I can take you through an example of Enron's, the company that collapsed in 2001, its official financial statements prior to 2001 presented manipulated balance sheets that were using off the books special purpose entities and prepaid transactions. The company's debt to equity ratio increased significantly from 2.49 in 1999 to a high of 5.33 in 2000 due to the hidden debt in concealed partnerships. The hidden debts were never registered. The company also depicted a healthy current ratio. All this led to the company's downfall due to non-disclosure of the true position of the company. When you read the Bible in the book of Proverbs, chapter 22, verse 7, it says that a borrower is a slave to the lender. So when you borrow money, then you become obliged to work towards paying that particular date. And in this case, I can use developing countries, which in the recent past have been relying on debt to finance their activities, in fact, including their current expenditure. And you'll find that these countries have used most of their major assets like airports, ports, as securities to acquire loans. And this has enslaved them to the lender countries. And in this case, we're talking about developed countries. This verse in Proverbs 22:7 then teaches us or guides us on how to work on our leverage as a business. In Matthew 25:14 to 30, the parable of the talents, it teaches about the master who expects a fruitful return and good stewardship of his resources. The master in this context would be likened to a shareholder who expects to receive dividends from the business and proper management of the business. The Bible, therefore, then would help us understand that we need our conscience in every business transaction or record we create. This would help us practice integrity in all our business dealings. As shareholders, as owners of this company, I would want you to focus not only on the ratios, but also the other factors that can cause either this business to move forward or can make it collapse. For example, we need to take a look at the cash flows after capital expenditure. This would help us understand how much money we have for reinvestment. We can also look at the earnings before interest, taxes, depreciation, and amortization, and deferred revenue. Um, all those, they form uh, other financial factors that you can take into consideration. But also, as owners, you need to understand that there are other non-financial factors. For example, customer retention. How do we keep our customers as a company? You look at the employee turnover. How many employees leave our company in a year? How many hirings? How many trainings we're supposed to do in a year? Then also you look at how the management has invested in innovations and technology. Such factors then would help us understand how the business is running, and ratios would become part of the factors that we consider in making our decisions, and it would help us then make informed decisions as investors. Thank you.